Welcome to the Prosperity Health GP series. As accountants and financial advisors who specialise in the medical industry, we understand that our clients are quite often time poor and unavailable during normal office hours. So for this reason, we've put together this series of videos on commonly asked questions, which will help you run your practice better and also control your personal wealth. In today's video, we'll be looking at the subject of tax deductions available to GPs. So Brendan, what can you say about this topic?
Obviously, to start off with, this is a fairly general topic that we'll be talking about, and deductions would be specific to the individual. So the advice we're giving here is of a general nature, and for specific advice on deductions and whether something is deductible to you, you should contact your accountant and advisors to confirm that. But that being said, what we're talking about today is hopefully giving some of the GPs out there a bit of an insight in some of the major deductions that they would incur and we find most clients incur.
Okay, so first cab off the rank, let's talk about conferences, memberships, subscriptions, those kind of things.
Always good to go to. Conferences are great, so easy one to start off with. Conference is a tax deductible. If you're going to a conference for the purpose of your work, then yes, it will be deductible. A couple of things to remember though, the flights there and back, so if you're flying interstate or overseas for a conference, you can claim a deduction for your flights, but keep in mind that if you are going to other events and not just this conference or the seminar, then the flight might have to be prorated. So if you've got a week at a conference and a week skiing, it's probably going to be 50% of your flight will be deductible. From that point of view as well though, accommodation is a deductible. So if you're staying at a facility to attend the conference, then your accommodation while that conference or seminar is on is obviously deductible as well. But even things that I guess people don't often think about, but should be, and things like transfers. So to and from the airport, how'd you get to the airport? Did you get a cab? How'd you get there? Did you get dropped off? We can claim your kilometres if you drove there. We can claim cab fares, those sort of things. And then even the little things like meals and incidentals. So while you're at a conference, if you're out buying meals while you're away from home, then yes, those can be tax deductible. Obviously it doesn't include copious amounts of drinks, but it does include your meals while you're there.
Okay, what about memberships and subscriptions?
So any professional membership, so any RACGP, APRA, any expenses you're incurring that are to do with you in the medical field or your work basically, then yes, that is deductible. So while it's best not to incur an expense, it is handy to know you do get a tax deduction for those sort of things.
Okay, I'm a busy GP, I've got to use my phone a lot. What's the view on
As
mobiles?
most do. So mobiles and laptops are probably easiest to talk to together, similar electronic sort of devices. And these days, a smartphone is essentially a computer. So from a point of view of what you can and can't claim, if you've got a phone that you are using for work, it is tax deductible. There should be some sort of percentage carved out for using it if you are using it for personal purposes as well. A busy GP will use their phone quite a bit for work, and probably for other doctors watching as well. If you're not a GP, if you're on the hospital wards, then definitely you'll be using it a fair bit as well. But it's really about coming up with an adequate percentage that accommodates your business use as opposed to your private use. The ATO have a bit of a guideline where they indicate a 4-week record period is something that they would consider appropriate, and obviously that 4-week record period of tracking how much you use your phone for work and personal should be an indication of your full year. It shouldn't be something that's just done at a heavy business end use. And once you've got that percentage, you can then apply that to your phone bills, and you can claim that as you go along. Keeping in mind too, a smartphone is more than just telephone calls you make. Obviously you're using a fair bit of that from a data point of view and from a computer style point of view, so it can be claimed that way. And laptops, I guess, from a similar point of view, it's based on a usage. Keep in mind also with your laptops and a little bit with your home phone as well, that it's not just the cost of the phone, the cost of the laptop, it's also potentially your broadband that you have at home as well.
Okay, another big area of expenditure for GPs can be equipment.
Very much so. Not just your loops, your stethoscopes, these sort of things. Obviously larger equipment you're buying for the practice as well, that is definitely tax deductible in the extent that it's used for the business. One thing to keep in mind, I guess, reasonably recently the ATO have announced that we can, if you're a small business entity and you classify as a small business under their guidelines, then you can claim deductions, immediate deductions for some assets up to $20,000. So that's a handy deduction to have in 1 year.
Yeah, and there's a time frame attached to that because that concession runs out in a certain period of time. Another big area of expenditure for GPs and all medical practitioners can be interest. How do we approach that issue?
Interest definitely can be deductible. By all means, don't steer away from this. The key part of interest, or the thing to remember, is the deductibility really depends on the purpose of the borrowing. So if you're borrowing funds to pay for business expenditure, then the interest connected to that borrowing will be tax deductible. One trap to fall into, I guess, that we try and avoid wherever possible is splitting a loan or pro-ratering a loan. So if you are borrowing money for a business purpose, it's best to have that loan just for business purposes. If you're borrowing money privately, keep it separate, because there is a bit of a pro rata that needs to occur when you're claiming that interest, and unfortunately repayments being made just get split against the percentage of balance of that loan that's private and business, and it doesn't work to your advantage often. So we'd suggest normally having a separate loan or a line of credit that you use for business expenditure. And sometimes that's not just the simple stuff as well. I mean, there are bigger items that you might be buying. Some of that equipment we were talking about earlier, you might be buying that, and if you're borrowing for that, then yes, that is deductible. So as long as you're getting a decent interest rate, it's worthwhile looking at whether you should be borrowing that, as opposed to the common other scenario would be to draw down from the home loan, and that's not always the best method.
Okay, what about insurances? There's a range of insurances which GP might be paying.
There is. There obviously a range of insurances, very important to protect your income. In fact, we've got another video series on that in particular, but it's important to protect your income. Just to give you an indication, I guess income protection is probably one of the bigger ones. Definitely insurance, definitely deductible. Indemnity insurance is deductible. Life and TPD can be deductible if it's in super. Your business protection insurances, they're definitely deductible. Property insurance, so that's another interesting one. If you've got an investment property, then that is deductible. But if it's obviously just your home loan your home that you're insuring, then that isn't tax deductible. That's private in nature.
Right. Okay, so another big area of expenditure can be the motor vehicle. How do the rules work for motor vehicles?
Now, motor vehicles, it's an interesting one. It's a bit of a grey area in that if you're travelling from home to work, your place of work, as long as it's a standard place of work, then that trip is typically not tax deductible. Where it can get interesting is if you have actually started from home and you have a home office, and I might touch on that next, if that's okay, a bit of a home office as to what qualifies as a home office. But if you're travelling from a place of work to another place of work, then that trip would be tax deductible. Likewise, I guess there's an argument as well for GPs that if you're carrying quite bulky and sensitive equipment, it is difficult for you to do that on public transport, and there is an argument that can be considered a work trip, which could make that travel deductible, but I'd suggest talking to your your accountant regarding that. In regards to the home office, it's important to make sure you do have a genuine home office established at home if you intend on claiming that trip from one place of work to another place of work. The ATO have some quite specific guidelines, and again, it's probably best to talk to your advisor about it, but things like having a separate entry are some of the big things they have. And then when you're working out that home office, it's based on a floor area, because if you are claiming a home office, then you may also be claiming a percentage of your interest or a percentage of your rates or a percentage of your rent on that home as well. So a bit of a tricky area, but one to definitely look out for and talk to your advisor about.
Okay. Now, I presume anything like protective clothing or items which are particularly used for work should be available to be claimed as well.
Most definitely. Protective clothing, probably the easiest one. There's a nurse ruling on non-slip shoes if you're in a medical area. So needle stick sort of drops, those sort of things. You want a fully enclosed shoes, you want non-slip. You can't necessarily claim your R.M. Williams, but you can definitely claim them if there are things like shoes, if they are specifically for a protection point of view, or anything you're using in your practice that is from a protective point of view. Unfortunately, clothing like this is not tax deductible.
What a shame. So that pretty much covers it from a personal tax deduction point of view. What about if a medical practitioner is practicing through a trust structure, which is quite common? How does that change things from a tax deduction point of view?
The items we've mentioned previously are still tax deductible. There's not too many major issues there, whether in your own name or in the trust, if you're trading through a trust. I guess having a trust in place opens up the door for a few other options. Trusts are great from an asset protection point of view, which we often recommend to a lot of GPs, just to keep the practice out of your name is very important. And when you've got a trust structure in place, there's often a few other things you can do. For example, vehicles. You can have a second and third vehicle in the trust. Now, while obviously if you're not using that for work, it's not necessarily tax deductible, but if the asset or the vehicle is owned by that trust, then it technically gets to claim a tax deduction for that. However, there is some fringe benefits tax that then comes in on the income side of the trust. And following the ATO guidelines, using their standard rates, that can be advantageous to work through, that you might be able to salary sacrifice a couple of those vehicles, and it can definitely still be advantageous, and it's worthwhile doing the calculations to check. Some of the other things you can do as well, obviously, if you're employed by the trust as the GP, which you often would be, then you're entitled to claim certain deductions. So you might receive a minor benefit from your employer, being the trust, and if that minor benefit is irregular and infrequent, and you receive that and it's under $300, then that sort of deduction would be deductible to the trust, but not necessarily income in your name. So you get a small benefit there. Also, when you're attending an event as an employee, there are some slightly different rules. So again, if your employer, the trust, is employing you, and you're going to a conference, it's paying for the conference expenditure, but it also might provide you with a travel allowance to meet some of your daily costs while you're away. And again, that might work out to be quite beneficial to you. And it's just a matter of knowing what the rules are and treating that employer-employee relationship appropriately. At the end of the day too, obviously a lot of people set up a trust they think they can distribute to family members. That can work, doesn't always work. Doctor's income is often PSI income, so personal services income. That can be quite tricky to deal with and often does stop you distributing large amounts of income to other family members. But in certain situations where you are running a personal services business and it's not personal services income that you're earning, then yes, there can be distributions to family members as allowed by the trustee. And probably another one to think about too is deductibility, I guess, and borrowing through that trust to get a tax deduction for interest, which we talked about earlier, which was the purpose of the borrowing. So if you're borrowing money obviously to make certain payments that would be tax deductible, some of those can definitely qualify, and interest in relation to that would be tax deductible. It's again a bit of a tricky area though. Just make sure you're doing it properly and make sure you're borrowing for the right purposes, and make sure you talk to an advisor who knows the area, knows it well.
One of the areas we haven't touched on, Brendan, in either personal or trust deductions, is the area of salaries or superannuation that might be paid in relation to family members.
Yes.
Is that something which can be explored from a tax deduction point of view?
Most definitely so. And in a trust situation, if you are employing someone to assist you, then that person can be paid a salary. It does not matter that they're related to you. What does matter is if they are related to you or not at arm's length, that you are paying them a market salary for the work they're performing. And as you rightly said, there's superannuation can also be paid on behalf of them. And the nexus, I guess, to the deductibility of superannuation is not necessarily that linked to that market value of salary as well, if I could say it that way.
Great. Okay, well, thank you very much. So I hope you've enjoyed this episode of our GP video series. If you're interested in more information on this video or on any other videos in the series, you can go to our website at prosperityhealth.com.au. You'll also find some contact details there for any of the team that you'd like to speak to. Thank you very much.
Thank you.